Hello again, this is Robert Schein, Managing Director and Partner with Blanke Schein Wealth Management. Well, today is Tuesday, May 12th, 2020, and I'm going to go through our daily updates as I normally do, market observations, insights, key topic and headlines that we're sourcing, just to continue to provide updates to our clients. It's our commitment to all of our clients at Blanke Schein Wealth Management, their friends and family. So thank you for watching. So our first topic we're going to discuss is the Federal Reserve. As I discussed many times, fiscal and monetary policy have come to the aid of the markets. Obviously, we're seeing that work through the marketplaces, both in the equity market as well as the fixed income market. In this case today specifically, I'm referring to the corporate bond market, investment grade corporates. Today, the Federal Reserve is starting one of the programs that they announced through this process weeks ago, that they were going to start buying, which is the first time ever, they've never done this before, ETF, exchange traded funds, in the investment grade corporate offering space. What that means, what the take home point is, well, interestingly enough, if you look at the fund flows ever since they announced that, meaning where money is running into and racing into on Wall Street, it happens to be investment grade corporates, as evidenced by the fund flow recap that we just showed, as well as U.S. large cap equities. And I'll talk about that in a second. But more importantly, on the investment grade corporates, the Federal Reserve is joining in the market, playing ball. I mean, essentially, they're supposed to be the referees and make certain that there's liquidity. But oftentimes, when there's crisis, we've seen this all too often, that the Federal Reserve then comes in and starts playing for themselves. So what that means is it's artificially supported, but that also means that there's a bid in the marketplace. And what they're ultimately trying to do is make certain that there's some liquidity in that space. There is, working through, again, support on all these corporations, on their specific debt that's outstanding. Again, we don't know the good with the bad, and I think that's their whole MO right here, much like they did with the banks in the financial crisis back in the Great Recession. So again, that's what's happening today with the Federal Reserve and the investment grade corporates. They're playing ball on the field, and they've done this in past, but not this specific program. So we're going to see how it plays out, but the fund flow is definitely betting on investment grade corporates right now. Now let's also look at the sector fund allocations, fund flow, and returns. Essentially, what we've seen, right, basically year to date, the three best performing sectors. Now, remember, the S&P 500 used to have 10, now they have 11 sectors. They took out real estate and made that an individual sector as it relates to the S&P sectors. And so you could take the Standard & Poor's 500, you could take each individual company, and you can categorize that relative to, what sector they should be categorized in. And so what I've done is classified best and worst performing sectors year to date from a performance standpoint, but coincidentally, it's also from a fund flow standpoint. So Wall Street fund flows, where money is being put to work, also indicates, not oftentimes, but also shows, where there's high conviction. And clearly we know that tech, even NASDAQ year to date, is positive for the year, simply because people are working from homes and they're utilizing technology. So this is sort of that renaissance that we've all been waiting for. As I'm speaking to you on this technology right now and using all my other technology, I'm sure you are too. So it's no stranger that this would be the best performing sector. Healthcare is number 2, and then consumer discretionary. The three worst performers, as you would imagine, energy. We saw energy, and we've been following energy. As we saw that oil had a pretty crazy ride over the last couple of weeks, followed by financials. Financials got hit by the yield curve. So when interest rates are falling, that means the net interest carry, or the margin that banks can make, is really just decimated right now. So there's no guidance on their corporate earnings right now. So that's why the banks are down. And then finally, industrials. So, factories and a few other things where non-essential sort of slowdown of the economy, both here and globally, those companies are hit. So that's just a recap of best and performing sectors year to date. Again, that doesn't predict the future going forward, but it's interesting to see at least where we are as it stands right now. Our last topic relates to homeschooling. Now, I've been blessed in the Schein household. We've got a couple high schoolers, a couple grade schoolers, and realistically, they haven't missed a beat. The educational system that we have our kids in is second to none. And we're truly grateful for that because of Zoom learning and rigorous schedules and so on and so forth. But a new study that I just found on the internet, I thought it was interesting. I want to bring to your forefront as it relates to sort of the economy itself and reopening, because 40% of the U.S. worker has a at-home child, one, maybe two. So in order for us to reopen the economy, we need to find a safe childcare aspect. And while most schools, if not colleges, are talking about the fall remote learning, this is going to be a continuing bigger issue for the U.S. economy and the productivity, and then i.e. corporate earnings. And if earnings can't grow, or at least maintain, there's going to be a lot of collateral damage in the months and years to come. So I think that's a bigger issue. But to leave you with this, that's why I keep bringing it to the forefront. We're going to continue to watch this. I obviously we got to trust all the medical experts out there and keep our children healthy and safe first and foremost. But it will become, it's like a sort of a drumbeat that's going to continue to persist as we go through summer and into the fall. And so let's keep an eye on that as we are. But let me just leave you with this last study. Might change your mind about homeschooling itself, but basically a study finds that parents can do a third of their kids' math, but they struggle with the other 3/4 of their math. So that's so I hope you enjoyed that joke, and thank you for watching and following as you do every day. Truly appreciate it. Have a great day.